Good afternoon and welcome to our session, Investment Strategies in Private Equity, Post-Corona, Risks and Opportunities. My name is Gregor. I'm head of M&A at PwC in Austria and I'm the moderator of this meeting. And now I would like to introduce our speakers. To my right is Stix, partner and head of investor relations at Mezzanine Management, a fund providing growth and expansion capital in mid-market transactions in Central Europe. We have also here in Vienna on the stage Wittlinger, investment manager at Russmedia Equity Partners, a PE investing into small-sized digital businesses in Europe. Then from Prague, we have Tatiana Balkovicová, senior investment director at Genesis Capital, a fund providing capital to small and medium-sized companies in Central Europe. And finally, in Munich, I can't see you yet, but we welcome Linus Lenhard, director at AGIC Capital, a European Asian PE investing into industrial and medical technology companies. So, Linus, for some reason, I cannot see you. This may be a technical issue we have in these times. So I would then start with one of our speakers here on the stage. Maybe, Christian, can I start with you with the first question? So Corona has hit us all together half a year ago. What is the situation today? What is your experience, your impact on your business? What are your observations?
Well, thanks for the introduction. First of all, touch on wood. Short answer to the question is that in our portfolio, things are pretty stable. Maybe to add to the introduction, our main strategies are providing mezzanine and growth capital. We currently invest out of our fourth fund, but we still have companies from the third fund active. So in total, at the moment, we have 9 investments in the current fund, and we have another 4 investments that are still active from the last fund. So we had a sizable portfolio that went through the current situation. But as said in the beginning, we had 2 companies that suffer temporarily, simply due to their sector exposure. The rest of the companies fared pretty well, and we also even had businesses that actually benefited from the situation. We like to invest in defensive sectors, so we invested in food manufacturing businesses that benefited from the lockdown phase in March, April especially. We have a PET bottle producer in our portfolio that benefited. So overall, so far, I think the impact on the portfolio performance was limited. We also went through a home office lockdown phase from mid of March to beginning of May. Since then, we are back to the office, so that transition was also seeming less for the moment because we are all used to traveling and working remotely. So I think there was no major impact on the current operations.
Thank you for that. Maybe Chris, same question to you. What were your experiences in these last months?
Yeah, sure. I'm afraid my answer is not going to be very different, very similar, right? So we went into lockdown, obviously, into home office. Wasn't a huge transition because we are a remote team, we are a small team, but across four countries, I think. So nothing changed there. We already used Zoom, so it was just kind of going out of the office and going into the home, basically. We invest purely in profitable niche marketplaces and software businesses across Europe, between 0 and 5 million EBITDA. So as you can imagine, quite a few benefited from the situation. So digital businesses in general did quite well. We had overall a good performance, I think. Online dating went through the roof, for example. Classified businesses had a short dip and then went back really, really strongly. Some exceptions like sport event organization or online ski rental went obviously down. But overall, we're quite happy.
Okay. Good to hear. Thanks. Tatiana, what are your experiences from Prague and in Central Europe as such?
Yeah, well, we invest in the Czech Republic and surrounding countries, Slovakia, Poland, Austria, and Hungary. Maybe just to add to the introduction, our current fund is almost fully invested, and we just started fundraising for the sixth fund. We have 10 investments at the moment, fairly well diversified industry-wise. Most of them are in the Czech Republic, where the measures in spring were, I would say, very strict at the beginning, but then were fairly early released, and people went back to the offices and back to work. Just generally, I can say that the portfolio is doing the best in its history, which is pretty much in line with what the gentlemen in the studio were saying as well. We did have one company which was hit significantly because of the industry which it is in, which is operator of indoor trampoline parks, which obviously had to close. But then we have some stories of businesses which did exceptionally well. Like we have a customized software developer, which is going very strongly. Then we also have a share in one of the leading retailers of consumer electronics, which used the opportunity and went online. So I would say overall, knocking on the wood, it's going well. One observation, it seems that it is really the management teams and their ability to react quickly, which plays a crucial role in how they can cope with the crisis or any unusual situation.
All doing well. Just one follow-up question on that. Is it because you are so thorough in your analysis right at the beginning before you invest into a company? Is it more or less a strategy to be as safe as possible, as one would of course also assume, or did you also have to some extent good luck that the mix of your portfolio was as it was, or is your management so good? What is the reason that we hear from all of these speakers it's so well? Is it the selection of AVCO to select speakers that can report on successes, or what is the reason?
Well, I think it's a combination of all those factors at the end of the day. I think a bit of luck plays also a role, because if you had invested in an online travel agency, for example, I mean, that would have probably, no matter how strong the management team is, that would have suffered. But we at Mezzanine Management, we like to invest in defensive sectors. We always look for downside scenarios, downside protection. Of course, such a black swan disruptive event no one can predict. But as said, we also did investments during the crisis. So since beginning of the year, we have done 2 new investments. One was in a specialized packaging business, and they mainly produce packages for pharmaceuticals and food production. So it's a very stable sub-industry at the end of the day. We are generally extremely selective when going through the deal flow. So at the end of the day, I think we will close 4 to 5% of all deals that we are reviewing. We have our local teams on the ground that do local analysis. We always include industry experts and due diligence providers, of course, like everyone, I guess, to have a very detailed view of the business model, of the numbers, the quality of management. We look at established profitable businesses, so businesses with a history. We also like to look, if they are long enough on the market, how they fared through the last financial crisis, which was another kind of disruptive event for some businesses. And I think these are the key factors. And the local office team for us is extremely important. Also, through the lockdowns, we were still able to meet portfolio companies because we have 5 offices in the region, and the people in Poland, they travel with the car to the portfolio companies. They meet regularly, and it's just really being close to the business and then being able to respond quickly if we see a deterioration of numbers, of demand, etc.
Thanks.
Yeah, I would say it was a bit more luck than skill, definitely. But I think for us, it's very thesis-driven investors in terms of where do we think digitization is going, and I think just Corona has now accelerated some of these trends, right? So we definitely didn't think of a global pandemic when we invested, for example, in Paul Camper, which is Airbnb for camper vans, right? But we saw the theme. We saw the theme that, okay, camping is really strong in Germany already. It's very strong in the German-speaking region, and it's growing really nicely across the globe. And then the global pandemic hit, and obviously they were impacted quite heavily. But then now camping is a preferred way to do vacation across Europe, right? So we had our thesis. Obviously, we are very careful in investing. We are also very conservative in terms of leverage, right? So worst thing that happened to us, okay, maybe we lost a little bit of EBITDA, right? But we didn't lose the company, which is really important to us to be on the conservative side there. And then the rest is just benefiting from being in the digital space, and I think the digital space in general just benefited from this crisis.
Okay, thanks. Tatiana, are you also conservative or lucky?
I would tend to agree that it's a combination of both, but we are very conservative and selective in choosing the companies or the investment situations we go into. I would say that out of approximately 200 investment opportunities we screen for a year, we typically invest 2 or maximum 3. So yeah, we do pay a lot of attention to understanding, as one of the gentlemen said, we do a thorough due diligence, but we do spend a lot of time with the management team, understanding the market, understanding the situation the company is in, how it does compared to the competitors, what is the risk profile, market cyclicality, all of these. So these days, of course, we also try to understand better what the Corona impact is or might be, because it's still not over, unfortunately, and how long it will last or what the impact will be and how the management is reacting to it or plans to react to it.
Did you change anything in your analysis, apart of what you said? Corona as a topic as such is something you look at, of course, but still, is it now? Did you change any strategy in doing this, or the processes, or how do you come to a conclusion if you want to, whether you want to invest or not? Tatiana.
Oh, it's for me. Okay. No, I wouldn't say we changed something specific. We're just being as selective as we were before. Yeah.
Okay, excellent, thanks. I just see that Linus seems to be on the line now. Hello. Can you hear us well? Excellent.
Hello.
Then I would just like to phase you in. We are talking about the impact of Corona in the last 6 months and the impact on the business. But also on how you do deals. Can you share with us your experiences in the last months?
Yeah, I think I would say the
yes, we cannot hear you. Maybe the micro is still on mute.
No, you should.
Yes, now we can hear. Yes, now we can hear you. Excellent.
Okay. No. So I would say it's the normal impacts that most people had. So you had to do a lot more virtually. So a lot of fireside chats that you would have expected normally to happen only in the on the face-to-face meeting. you start not to do this virtually. And we also have some management presentations which also happened virtually, and then I think that has become really a topic in many aspects. So on the one hand, I would say people are getting used that traveling is not possible anymore. So you're getting a kind of efficient in that regard. On the other hand, I think trust, branding, also track record is becoming even more important, because it's a little bit harder to build a personal relationship when you don't travel and meet the persons, one by one.
Understood. Is a personal meeting a must before you do an investment?
Yes.
No, of course.
I mean, we always do a personal meeting. What we do at the moment, I mean, there's one deal where we had one personal meeting for 2 days, and then we had 5 video conferences afterwards.
Yeah.
And you always need to have the personal touch, but things for which you have traveled in the past, you do know virtually. And I think you need to get used that the advisors you're working with, you might never really have met them in real life. This is more something you have to get used to, rather than it's really impacting the way you're doing. But it's an absolutely must that you meet the people, because you have to see if there's real chemistry. I mean, it's really like marrying, so you have to get comfortable with each other.
Yeah, thank you. Chris, you are doing business in digital still. Do you need personal meetings with the management?
Yes. I think a lot of the whole due diligence process went virtual, which I think is a good thing, right? But I think you really need, well, first of all, you need to make sure that the company actually is there, right? So we're at very close stages with one deal in France, and we haven't been able to travel there yet, right? So I can't, obviously we did a due diligence, right? But you still want to have this like kind of last meeting to meet the seller, to meet the management team, to make sure
you
there
never
is a
met
chemistry.
them yet personally. You did all the way
So far, yeah.
and just before signing, if the management meeting is going bad, then you don't sign.
Yeah, I feel like there have been much more interaction virtually.
Yeah,
like we spent hours and hours and hours and hours in video calls to make sure there is chemistry, to make sure we are aligned, to make sure the people are there. The management team came over to Vienna when the travel was possible. The travel back to France is a bit difficult right now.
Okay. Yeah.
But we haven't met the seller yet, so that's one remaining thing. We really need to make sure that that's okay.
Yeah, I mean, I also think that management, a personal meeting these times is a necessity, isn't it?
Yeah.
You have people on the ground, as I understand.
Exactly. So I think this is the recurring theme for us as a group, as we really invest a lot in our office network, in our team, to have people on the ground. And as all the others said, personal meetings, physical site visits, this is still key for us in every due diligence before we even consider investing. So in that respect, the process has not changed. Of course, all the steps beforehand and also a lot of steps after that move virtual, which actually in our experience can also increase in efficiency in various cases. But the personal meetings are always there and always important. And again, here the local team comes into play. So I think we have now, since Corona happened, we have done 2 new investments. So we have real life examples. We have also had in the last 12 months 7 exits in our portfolio. So also the last couple of exits were done mainly virtual. Of course, always with personal meetings, but it's a proof that this works. And again, I think the local team is key, because if we have an opportunity in Poland, we don't have to observe any travel restrictions or Corona tests coming in and out, because we have the local people on the ground. Same in Czech Republic, Romania, Hungary. So I think this is one of the advantages of many being local.
Thanks. You were talking about exits. Was there a special challenge in these times? What was it? Yeah.
Yeah, I think in one of the investments we recently did, in all fairness, we did most of the due diligence before all the lockdown and travel restrictions happened. So there was a lot of normal physical interaction with the company. We had far advanced price discussions. I think one thing that we and other involved parties then brought up to the table in this transaction was to consider price reduction because of the current market environment, which ultimately was granted. On the other hand, we have also had our exits where we have seen certain delays happening, also in all fairness from the banking side in one or the other situation where the banks stepped a bit on the brake to reassess the current situation. In one or the other situation, there was also a push by the financing bank of the buyout for an increase in prices. So ultimately, we all came together. I think ultimately, as we are in sectors that are more defensive, that are generally growing also in this environment, we, when faced with our exits, were not agreeing to any price reductions because in many of our companies, the revenues are contracted. It's very predictable cash flows for the next 1 or 2 years. So this also made the buyers comfortable that they are buying on the basis of stable numbers. Basically.
Excellent. Tatiana, you are also on the one hand side a growth investor, and I think also for your private equity part, you are leveraging with bank debt. What is your opinion and your observation with regard to financing, debt financing, or something similar?
Yeah, well, in terms of acquisitions, we've done one acquisition since basically spring, and maybe worth to say that we were always moderate in using acquisition finance, bank financing. We didn't have a problem, but we do see that banks, when we discuss new opportunities, are more cautious, especially when it comes to acquisition financing. Then that would be one part, but then we have a few businesses where we talk about expansion or growth, and there the situation is more complicated because one of them was affected, so the EBITDA is not at the level it used to be, and we are now just exploring different options, such as private debt funding or even public bonds issuance. We are still evaluating the option. We haven't decided yet, but we went also this way, which for us is kind of innovative because so far we've been mainly using the banks.
What about fundraising? Is there anybody in fundraising? Is this something where you, Tatiana, I know. Is this something that has changed now, or what is the environment for fundraising now? Tatiana.
The environment for fundraising doesn't seem to be very affected, or at least not negatively, what we are seeing. We started fundraising, we officially announced we are starting fundraising at the end of June, so really before summer months. And after those 3 and something months, we are seeing quite a lot of interest. It seems that there is a lot of money on the market. And it's not only from our current investors, but also new ones. It's maybe worth to say that we have institutional investor base, renowned international and Czech institutions, being banks or insurance companies, funds of funds, etc. And we are also seeing interest from banks that are looking for investment products for their high net worth clients who would like to invest and are looking for other alternative ways where to invest.
Thank you. Any more on fundraising? Any?
Well, I may add to this. in the introduction, what was not mentioned is that we are actually a multi-strategy asset manager. So we have our main strategies, which are mezzanine growth capital, but also over the last couple of months, we have expanded into 2 other fields. Over the last couple of months, I mean, we launched and we had a first close of a growth equity fund in August. So this mainly, all of the fundraise was done during the Corona situation. It's an SME-focused growth equity fund focused only on the Adriatic region, so ex-Yugoslav countries. And that was main due diligence with international investors like the European Investment Fund, which is a cornerstone investor there, was done before the lockdowns happened, but then all of the long way to getting them to signing was done virtually. And we had strong support from local institutions, mainly pension funds and insurance companies. Simultaneously, we are now preparing the launch of a pioneering direct lending strategy for Central Eastern Europe, a fund that will mainly provide senior secured credit in response also to the situation, and also as an alternative to bank financing, which in many situations is not readily available for SMEs in our market. And there, obviously, we are now in the midst of fundraising, so we very much see the differences. I would agree with Tatiana. The appetite of investors is there and is also increasing in various areas for alternatives, because I think many institutions have understood that alternatives bring a benefit also in terms of volatility, especially during those times. We have seen a couple of institutions, pension funds, that, for example, have allocations to certain asset classes that would like to allocate more, but they can't at the moment because some of their more liquid strategies have reduced in value, which relatively increases their allocation to alternatives, and they are at the limits at the moment. But I think the impact, one of the benefits of being on the market for 20 years is that we have a broad base of existing investors, both from Europe, but also from the US and Asia. So in discussions with existing investors, there has not been that much of a difference. So you do it virtually, they know you. Some institutions, for them it took a bit of time to move to virtual due diligence, but this transition has been done now. Where we do see an impact is definitely with new contacts that are not locally reachable. So we also have a broad network in Asia with Asian insurance companies, pension funds that have taken a stronger interest in Central Eastern Europe as a growth region. And for them, it's currently difficult. So all overseas investments are blocked at the moment because they cannot travel and they cannot physically meet the manager, which is still a requirement for many of those institutions. So it's a new environment. I think with the existing investor base, it's going well. We are progressing quite efficiently. But for new introductions, new outreaches, the traveling is obviously missing. And I would say that international institutions like the EIF, like the EBRD, especially for our region, also have gained even more of importance as enablers of first closes, because they can basically push a manager over their target. And we all know once you have done a couple of deals on the books, it's easier to get in new investors.
Thank you. You gave us the keyword Asia. You talked about difficulties. Linus, I think this is also a keyword to you with your European and Asian angle. Can you talk about your experiences with Asia in this environment?
Yeah, I think Asia is really a strong positive, I would say, not only for us, but really for every company which is exposed to that region at the moment. They have handled the whole situation extremely successful. So while we've seen, for instance, in our portfolio companies in January, February, you had some dips. But really, the reason why several of our portfolio companies are currently even growing is because of Asia. So we invest into strong companies in Europe, which have particular growth abilities in Asia, and I think helps us. But this is true for, I would say, every company which is internationally diversified. And I think this is also what you have to keep in mind also for the next years. If you think of where can growth come from, where are technological innovations coming from, in particular if you think of all apps on the mobile phones, etc., etc. You do see a lot of this coming from Asia here, and we do believe this is not only the growing region for the future, but we also believe to have a close eyes on the local competitors there is quite important to get a feeling of how successful your company can be within the next 5 years. In the past, it was always, okay, can European companies grow in Asia and enter the Asian market there? I think the question for the future, or the future 5 years, will also be, how aggressive will Asian companies get into Europe, get into the US, and really attack the established players. And this is not only true for the traditional fields where the Asian players have been strong already, but we see this also in medtech and all technology-related aspects. So the Asian companies, in particular the Chinese companies, have gained a lot of strength, and you need to prepare your companies in Europe to be able to compete and also to be able to grow. And I think that fits quite nicely to our strategy. But I think this is something every European company has to be aware of.
Thank you for that. Is fundraising an issue for you at the moment?
No.
No. For you, Chris?
Sorry. I would in generally say, if the performance is right, and this is what I'm hearing from almost everybody, there's so much money in the market, and all the funds that you think are kind of successful are thinking of doubling the existing fund. I would say, money availability is not the problem, is to invest it smart, and competition on the money side will increase even further. So I think it's going to be a lot more severe in the next 5 years than it has been already.
Thanks. Is fundraising an issue?
Well, we are a single LP vehicle, right, funded by Russmedia, and I think we are now 60% through our commitment. So we still have 45 million euros to invest, so that will bring us through a couple of more years. And we are also able to reinvest our cash flows that we generated, our businesses generate, so we don't see issues there. However, I have to say, on the debt funding side, it's definitely getting tougher. We're kind of triple dipping here. From our perspective, we have small cap is always hard, right, to find debt financing, because for most M&A banks it's too small. Then digital businesses, most banks don't understand really digital businesses. They don't know how to rate that, because you have very asset-light balance sheets, but you have nice cash conversions. So we see a lot of issues there. And then the third, obviously, is with Corona, they very much focused on existing business rather than new business. So that is where we face more challenges right now, particularly actually in Eastern Europe and Austria.
I'm very curious on the issue of how you see the market altogether, also, and also this potential shift from the past to now and to the future. In terms of prices, in terms of opportunities, and other challenges, what is your observation in these times?
So during the lockdown, basically, we made a conscious decision to know we're going out again. We want to be actively pursuing deals. We do not depend on leverage, so we can do deals pure equity. So let's go out there and get some deals in. Unfortunately, there weren't that many during the time, so we did one distressed deal. We did one distressed deal. During that time, that was a bolt-on acquisition that worked really well. Apart from that, we haven't seen much activity in that regard. So in terms of distressed deals, we didn't see a lot yet. Which I guess.
Do you expect them to come?
At some point, when the short labor measurements of the German and Austrian governments end, then there certainly will come something on the market. Hopefully, a lot of assets are now over leveraged, so they will need equity. So there should be some wave. It's just a question of time, I think. But overall, the general market, I think, is now back to normal almost. So we've seen an increase in deal flow in the last couple of weeks, actually, with a lot of assets on the market. What we do feel is that there is less competition. So I'm not sure about pricing. We tend to be very price sensitive. And so there are quite a few deals where we might lose out based on price. And that seems to be much better now, right? So we seem to be more on the winning side now, which I think is based on less competition.
Okay, thanks.
Maybe commenting from the mezzanine growth capital and also the private debt side in general. I think in terms of pure number of deal flows, cutting out maybe March and April, which were really like the lockdown months, we have not seen a big dip in the number of deals we're looking at. I think what we have seen is a bit of a shift of the type of transactions. We have a pretty flexible product, so we can do support buyouts basically. We do a lot, roughly 2/3, 70% of our deals are in the sponsor-led space, where we work directly with mid-market companies and provide all sorts of expansion funding on the equity side, but also on the debt side, mainly for add-on acquisitions, geographical expansion, etc. And that has shifted a little bit. We have seen now an increase in what we call special situations or opportunistic situations, not so much distressed. Although we also do look at that if operationally the business model is sound, but more where there is an opportunity for a distressed seller who wants to get out, maybe management wants to take over back control. So we have had a few founder-led MBOs, if you will, that we supported. So this we have seen in terms of pricing. When I look at our exits that we have done over the last 9 months, we have not seen a dip in prices. I think we have had our exits with double-digit EBITDA multiples, depending on the sector. So there was no dip in that. We are ourselves always very conscious when it comes to pricing, although it's less of an issue because we mainly provide our capital as debt with equity upside. But we often go in with equity kickers and warrants, which we get for free basically, and we try to secure our exit pricing via put options, for example, where we have a kind of a floor multiple agreed from day one. So we are protected here. On the debt side, with regard to debt pricing, we do see the ability for slightly higher margins now in recent transactions, because I can agree. We've seen certain dips on the availability of bank financing, depending on the industry, depending on the size of the business. Banks have definitely become more selective and even slower in many situations than they were before. So availability of capital is, I think, key as often in these environments. And we have had the benefit of most of our team is with the firm for more than 10 years. And we have gone through the last financial crisis together. So we know that in those disruptive moments, you can also strike some really good deals. If you look at vintage year returns of funds, you see this as well. And we are patient in terms of selecting the transactions. So we are well invested from our current fund, also around 60%. We still have enough time in the investment period, so there's no rush for us to strike a transaction.
Mm-hmm. Interesting. Tatiana, is this similar in the region you are active in, and also what do you expect for the future? Do you wait for prices to come down and for better opportunities to invest? Maybe like we heard this vintage argument, or what is your observation and your strategy for this for the next months and potentially also next year?
Yeah. Well, I would agree with the gentleman that since spring this year, there hasn't really been a huge dip in the number of deals coming. It's also worth to say that last 2-3 years, there was a huge increase in the M&A activity in the region. I would say that the number of opportunities we would be looking at a year would double. So there was probably some decline in March, April, maybe a little bit May, but since then the new opportunities are coming in, some of them really interesting. We here, in addition to what was said, see maybe more Czech-specific source of deal flow, and that's succession. And it has to do with the history when approximately 30 years ago the communism fell. The first generation of entrepreneurs who started building their businesses right after that is now approaching the age of retirement or reconsidering their life options and is looking for successors. And it's very often because the tradition here is not perhaps as in Western Europe that there would be a natural successor within the family. It's very often not. So they're looking for other options, and financial investors or private equity are very often a very natural choice. And this has been a trend on the market since some time, and given the time we are in and also the age of these people, it will last for some time. And what we are seeing, what we think will come, is that some people already approach the age when they would naturally leave their business or gradually leave their business to a successor. But Corona perhaps can speed up their decision-making process because they have some experience from turning around their business when it was hit by the crisis 10 years ago. But now they're 10 years older and they don't really feel they would like to do the same again. So that's one part of the deal flow, apart from that we think businesses will need capital because pure bank financing might be more difficult to get these days. And then we also see, and we're seeing a few examples on the market now, that very often bigger corporations, international ones, are these days reconsidering their strategy and very often refocusing on their key markets and disposing or carving out their local divisions or subsidiaries. Who are very often profitable, have very good management team in, and it's something like a life chance for that particular management team to team up with a financial investor and take over the business that they've been already managing and know for some time. So yeah, these would be the opportunities in the deal flow. In terms of pricing, we are not really seeing that the prices would go down. Perhaps the expectations of the sellers are getting more reasonable. They understand that the situation is difficult and unclear, and if they're really willing to sell and don't want to wait, then they obviously have a more reasonable expectation. But what is good is the structuring of the price. So it is now much more common and understood that because this year is affected, we would like to have some kind of an earn-out or a deferred part of purchase price dependent on actual results delivered over a certain time. Yeah.
Linus, Linus, did Corona change your view on the market, or is it just changing your view? What are your expectations, or what are your observations on pricing, deal flow, and so on?
I think it depends always on your fund strategy. So for our fund strategy, we do not see any decrease in prices. We would rather see the opposite. So you know, we do look a lot at technology leaders.
Excuse me, just to ask, why the opposite? Why do you think that prices will rise?
Yeah, because the scarcity of assets. I would say there's the number of players in the market is continuously increasing, but the number of really successful companies is not. And Corona has even made a harder cut here between the companies which are able to be stable or even increasing, And for these, I think you would see prices going even more up. And this is also what we see. So the indications we get for our portfolio companies are 3 to 4 turns higher than we would have asked 2 to 3 years ago. But also when we're on the buy side, for the right targets, people are getting quite price aggressive here. And I would say if the quality is right, this should normally pay off. On the other side, for companies which are mediocre, I think you would almost see a decrease in prices. So I could see that maybe the middle is dividing a little bit into really top companies and average or below average companies. While for the first group, you will see a real fight of investors. For the other one, will be a little bit fight for money. But for the real high quality companies, I do not see any price decrease. There's just too many players out there, and you just need to differentiate yourself and your investment story enough to be successful in that competitive market.
Mm-hmm. Mm-hmm. Thank you. Chris, what is your view on the market? What has changed, or what are you expect to be changed?
I think in most of our markets that we're active in, so niche marketplaces, software companies, didn't really change a lot. Like I said, we see less competition in the market, which is good for us. So there seems to be quite a few small cap investors who pulled a little bit out of the market. Mm-hmm. We see more opportunities coming to the market. So similar to what Tatiana said, is we see quite a few opportunities where the kind of entrepreneur had it. Basically, after 2008, he says, okay, I'm in my 50s, I'm not doing this again. I just want to sell. So we've seen that quite a few times, which is good for bolt-on acquisitions, not for standalone. We wouldn't do it standalone, but we would definitely do it as bolt-on acquisition. So we're getting more active on the bolt-on acquisition side, where we also think that there will be more distressed companies on the market. But for standalone acquisition, I don't expect too much change. Mm-hmm. Prices have softened a little bit, but not too much.
Thank you. My last question. A crisis has not only downsides but also upsides. What is your learning, or what is your view on what are the pros of a crisis like we just saw it? What are the advantages or the learnings?
Yeah, I think Christian already said it, right? So the vintage years of PE funds that are active during crisis years are the best, right? So obviously we hope to get great assets at very good prices, mm-hmm. and then are able to exit during a high, right? And that's, I guess, is the hope of every investor, right? Buy low, sell high.
Thank you. In contrast to that, Linus, you are not expecting better price opportunities. So what are the advantages of a crisis for you?
I think one of the most interesting aspects is at the moment when you talk to owners is they realize that it's not going always up. So in 2017, 18, 19, there's always the perception it has went up in the last 5 years, so there's no reason why it shouldn't continue like this. So even though everybody were aware of that, it was kind of hard to argue that the next crisis will come next year or the year after. Now you will end up in a lot more balanced discussion. So you do see how the companies are resilient in a crisis or not, and I think what you have to focus on even more is not only on the financial performance, but really on the quality of the products and the quality of the setup of the company. And for instance, for us, the discussions we are currently having, none of our offers is really based on the 2020 numbers only. You always should look what kind of adjustments do you have to do if any. So for us, I would say we We have also in the discussions with the owners, you get a little bit away from the traditional, okay, what is the performance in this year, but rather what is the perspective in the next 12, 18 months, and then what is your real vision then for the next 3 to 5 years. And that makes it even a little bit more interesting, because that should be a little bit the core also of the discussion when talking with management and the owners.
Thank you, Linus. So to conclude, thank you very much for these interesting views. We saw that we learned in this crisis that all together you managed your business and your investments very well. There are also opportunities. Not everything is that bad. We see lots of opportunities, also different, and I think this is a good outlook for the next months to come. Thank you, everybody, for joining this session.